They say there is no such thing as magic in the investing world, but there are 7 stocks that defy all odds and have collectively brought a magnificent return of 107% in 2023. Together, their profits now exceed almost every country in the world adding up, and they were once referred to as the FANG. But now, we have entered the era of the Magnificent Seven. They are Apple, Microsoft, Google's parent company Alphabet, Amazon, Nvidia, Meta, and also Tesla. If you do like their sexy returns and are looking for an ETF that tracks the Magnificent Seven, you have come to the right place. So in this video, I will walk you through the exact ETFs, their close comparisons, and my take on who's the winner. Now, to help you make a better judgment, we are going to compare 4 ETFs side by side, with one of them having 100% exposure on the Magnificent Seven, and another 2 are a little bit more diverse, and lastly, we will set the popular QQQM as a benchmark for the comparison. And among these 4 ETFs, some are more expensive than the others, and some would impose extra risk here and there, so make sure you watch until the end to know what you are getting yourself into. And as always, if you want to invest in any of the ETFs mentioned in the video, you can use my link down below to open an interactive broker's account for yourself and start investing immediately at a super low fee of 35 US cents only, and they even support fractional shares trading, so you would have no issue affording any one of the ETFs. So first of all, let's look at the most discussed ETF that actually really focuses on the Magnificent Seven, the MAGS ETF. So at this moment, there is no index available that tracks the Magnificent Seven. Hence, this fund has to be actively managed by the fund manager themselves. This would mean 2 things. Firstly, the fund will be rather expensive at 0.29%, and that's only fair because the fund managers have lots of extra work to do. And second, unlike passively managed S&P 500 funds, you can close one eye and choose either SPY, VOO, IVV or equivalent. In this case, who you choose to manage your fund will actually be very important. Anyways, the MAX ETF was only incorporated rather recently ever since the bull run, so we have a fairly limited track record. MAGS ETF was launched on the April 11, 2023, and the 1-year return was exceptional at 63.48%, which is significantly higher than the same period return of S&P 500 at 28.4%. and Nasdaq 100 at 42.16%. So although it's too early to judge based on past performance and returns, we can still look at the fund composition and you can decide based on your personal preference. Overall, MAGS gives you an almost equal exposure to all 7 stocks, and the portfolio is a combination of stock and also total return swaps. What it means is basically instead of buying actual stock, they are making use of some financial tool that allows the fund to purchase the asset without forking out huge amounts of capital. And while it has its own benefits, we are also imposed as an investor to some extra risks like counterparty risk, default risk, and also interest rate risk. I personally prefer physical replication that holds the actual stock, but synthetic replication is not all bad either, since it is the only available option here. So if MAX does not sound perfect, we have another 2 more ETFs that also similarly focus on large cap, basically companies that have market cap exceeding $10 billion. They are both physical ETFs that have real stocks as their underlying assets, and what's even better is that their fees are also much cheaper. So here we go, introducing MGK and SCHG ETF, where the former is Vanguard Mega Cap Growth ETF, while the latter being Schwab US Large Cap Growth ETF. Hearing these 2 familiar names made me feel much more secure, and it's even better to know that both funds have been around for more than 15 years. Yeah, that's solid. And in terms of holdings, MGK is more focused and has a 57% weightage of MAX 7 stocks and only 79 number of holdings in total, whereas SCHG ETF on the other hand is a combination of around 250 companies, but surprisingly, their weightage of MAX 7 is close enough to MGK at 51%, so not that bad either. And if we look at the size of their funds, both ETFs are at an equal scale of around 20 billion US dollar, with SCHG being slightly larger than MGK. But all said and done, the most important factors left are the fees and also their returns. And yes, we found a winner over here. SCHG has a staggering 43% of 1-year return, 13% of 3-year annualized return, and 19% of 5-year annualized return. And while MGK has had a great return and showed a similar trend, SCHG ETF over here simply outperformed MGK in all 3 time horizons. And while of course past performance doesn't represent future performance, SCHG also has extremely low fees at only 0.04%. So even though MGK's fees are, to be honest, quite low already at 0.07%, it just couldn't outshine SCHG ETF. And there are also VUG and SPYG ETF that are rather comparable to SCHD, but I did not include them in this table since they are just slightly inferior to this one. Now finally, we'll look at the Benchmark ETF, and a lot of you might have heard of it already. It's QQQM by Invesco that people usually buy if they are bullish on the US tech industry in general. If you already know QQQ, essentially, QQQM is the little brother of QQQ, managed by the same company that is simply better for long-term investors with lower expense ratio. Overall, QQQM holds about 200 companies, and the 7 US big tech companies took a weightage close to 40% of the entire portfolio. And while it is of course less than half and not really Mag 7, we are already getting a higher weightage of Magnificent 7 as compared to VOO or S&P 500 that has slightly less than 30% weightage. Overall, if you look at it, QQQM has given some solid returns, especially the 1-year return that goes around 42%, and their expense ratio is only 0.15%. Of course, it is not the ETF that imposes the highest or the lowest fees here, but I would say it falls right in the middle. So after having all 4 ETFs compared, here's my take on buying the Magnificent 7 ETF. The Mag 7 focus ETFs like MAGS is indeed a fair choice if you want exposure to the Magnificent 7, but you don't want to buy into each stock individually. However, I must say this, I'm held back a little by the fact that the underlying assets are synthetic and are simply too new to the market. So buying the large cap ETFs do seem to be a great alternative to QQQM because 1, you have more exposure on the 7 tech stocks Mag 7, and 2, they have lower expense ratio, which equals to potential higher net return over the long run. And out of these 2 large cap ETFs, if it's not obvious already, SCHG ETF has displayed a stronger number overall. But of course, let's not forget that these tech giants have a rather rich valuation and have grown significantly for the past few months. So you still need to take into account their valuation, the rather volatile nature of the US tech industry, as well as the high interest rate environment. They all will play a part in affecting the future returns of your investments as well. Alright, that's all I have for now. Hope you like it short and sweet. Do hit the like and subscribe button down below if you found it helpful, and do comment down below which ETF here is your preferred choice. Until then, if you are new to the stock market and you are not sure what are the best ETFs for first time investors, I highly recommend you check out this video. See you over there.